Hello, I'm James, you're watching Accounting Stuff, and today we're back with another special compilation. This time I'll give you a complete guide to adjusting entries in around about 40 minutes. This video is split into 5 sections. First, I'll explain why we need adjusting entries and introduce you to the 2 main types, prepayments and accruals. Then we'll dive a little deeper and cover each adjusting entry individually with examples. We'll go over prepaid expenses, deferred revenue, accrued expenses, and accrued revenue. There is a lot to cover, but if you watch this right the way through, then you'll be an expert in no time. So, what are adjusting entries? Adjusting entries are journal entries that we post at the end of each accounting period to bring a business's books in line with the accrual method of accounting. Let's jump in.
Financial accounting is the process of recording, summarizing, and analyzing an entity's financial transactions and reporting them in financial statements to its existing and potential investors, lenders, and creditors. So ultimately, as financial accountants, our job is to produce financial statements to assist our key stakeholders with their decision making. But what are financial statements?
You can think of them as formal reports that summarize a business's financial performance, position, and cash flow. Collectively, they give all of the interested parties an idea of the business's financial health. When preparing financial statements, there are some rules that we need to follow. The specifics differ slightly from country to country, but broadly speaking, we follow the generally accepted accounting principles, GAAP for short, or the International Financial Reporting Standards, IFRS. Now, both GAAP and IFRS have something in common. They both require us to produce our financial statements in accordance with the accrual basis of accounting. Now, the accrual basis of accounting is key to understanding adjusting entries. So what is it?
In accrual accounting, revenue is recognized as it's earned and expenses are recorded as they are incurred,
regardless of when cash or an invoice changes hands. But the key takeaway here is that payments and invoices shouldn't dictate when we recognize our revenues or expenses. Instead, we need to think about the substance behind each transaction. That's the real trigger. But the problem is that this doesn't just happen naturally, and that's when adjusting entries come in. Let me explain. A normal business transaction involves 2 parties, a buyer and a seller. The seller provides goods or services to the buyer and sends them an invoice, and in return, the buyer repays them in cash. So there are 3 parts to this transaction. We have the transfer of goods or services, the invoice, and the payment. Keep that in mind for a moment. Alongside all of this, the financial statements we produce are designed to cover a range of time, which we call an accounting period. Depending on the business's reporting requirements, this could be anything from a month to a quarter or even a full year. If all 3 parts of this transaction happen in one accounting period, then we're all good. No adjusting entries are necessary. But when they fall into different accounting periods, then we've got a problem. This is where adjusting entries come in. There are 2 main types, prepayments and accruals. Prepayments occur when goods or services have been paid for in advance, whereas accruals happen when goods or services are to be invoiced in the future. In a prepayment, goods or services have been paid for in advance. I'll show you how this works. I think it's best if we think of this in terms of 2 accounting periods, the past and the future, with us being bang in the middle, balancing on a tightrope in the present. In a prepayment, goods or services have been paid for in advance. So that means that the payment happened back in the past for goods or services that are going to be delivered or consumed in the future. The problem here is that normally the invoice and payment part of the transaction naturally triggers an accounting entry that recognizes the whole transaction in the past. So if we were the buyer, then we would have recognized an expense in the past. And if we were the seller, then we would have recognized the revenue in the past.
But we are accrual accounting, so revenue should be recorded as it's earned and expenses should be recorded as they are incurred.
The goods or services are going to be provided in the future, so the revenues or expenses should also be recognized in the future, not the past. So right now, before the period closes, we've still got a bit more time to make changes in the past. we need to post an adjusting entry to reverse out those revenues or expenses from the income statement and hold them in the balance sheet where they don't impact our past financial performance. Then in the future accounting period, we'll post another adjusting entry to release these from the balance sheet to the income statement. So we've correctly recorded our revenue as it was earned or our expenses as they were incurred. That's how prepayments work in general, but really there are two types depending on where we fit into the transaction. We have prepaid expenses and prepaid revenue, which is more commonly known as unearned or deferred revenue. If we're the buyer in the transaction, then we're dealing with prepaid expenses because we're the ones receiving or consuming the goods or services. However, if we're the seller, then we're on the other side of the transaction and we're dealing with prepaid revenue because we're the ones providing the goods or services. Accruals occur when goods or services are to be invoiced in the future. These are almost the opposite of prepayments. Goods or services are delivered in a past accounting period, whereas the invoice and eventual payment come later in the future. Again, we have a problem. The accrual basis of accounting is telling us that revenues or expenses should be recognized when they're earned or incurred. In this case, the substance of the transaction happened in the past because that's when the goods or services were delivered or consumed. However, the natural accounting trigger in this situation happens in the future when the invoice is raised by the seller and received by the buyer. So as things currently stand, the transaction is going to be recognized in the future income statement. To correct this, we need to post an adjusting entry into the past accounting period to accrue the revenues or expenses into the income statement. And the other side of that journal will be to temporarily hold the accrual as an asset or liability in the balance sheet. In the future, once the invoice has been raised by the seller and given to the buyer, we'll need to reverse this accrual so that we aren't recognizing this transaction twice. That will release the original adjusting entry from both the income statement and the balance sheet. Again, there are two categories of accrual: accrued expenses and accrued revenue. If we're the buyer in the transaction, then we're dealing with accrued expenses because we're the ones receiving or consuming the goods or services. However, if we're the seller, then we're on the other side and we're dealing with accrued revenue instead because we're the ones making the money by providing those goods or services. So adjusting entries are required to bring our books in line with the accrual basis of accounting, which is required under both GAAP and IFRS when producing financial statements. Adjusting entries are divided into two categories. Prepayments occur when goods or services have been paid for in advance, whereas accruals occur when goods or services are to be invoiced in the future. If you're on the buying side of the transaction, then you prepay or accrue expenses depending on the timing of the payment or invoice. However, if you're on the selling side, then you defer revenue when you've been paid in advance, and accrue revenue when you've already provided goods or services and plan to invoice the customer in the future.
Right, now that you've got a feel for why we need adjusting entries, let's take a look at some examples. We'll start off with prepaid expenses. Before we jump in, you should know that I've put together an adjusting entries cheat sheet. It summarizes all of the key points that I make in this video on one page. You can find a link to that down in the description.
A prepaid expense is a future expense which has been paid for in advance. Now, what does that mean?
It means that we made the payment in a past accounting period, but we don't actually receive the underlying goods or services until a future accounting period. Right, time for an example, but first, I want you to meet someone.
This is Betty, my humble Toyota Yaris. She's not the biggest, and she's certainly not the fastest. In fact, she's kind of old, but she moves me around from A to B, and for that privilege, I have to buy car insurance. Unfortunately, I live in Vancouver, which has some of the highest auto insurance premiums in Canada. Poor Betty, who I bought for $3,000, cost me a whopping $2,400 to insure for 2019. I paid for this in advance on December 15th, 2018, and I initially coded the whole payment to insurance expenses.
Question: what monthly adjusting entries do we need to post to record this transaction in line with the accrual basis of accounting? We'll begin by taking stock of the facts At the end of 2018, we'd already paid for our insurance coverage for the following year.
So, this was a future expense which I had paid for in advance. Does that sound familiar? Yes, we are dealing with a prepaid expense.
I paid $2,400 in advance on December 15th, 2018, which I coded to the insurance expense account. Now, what would that journal entry look like?
Well, I paid out $2,400, so my cash balance has to decrease by $2,400. Cash is an asset, which is the A in dealer. That makes it a normal debit account. So debits increase it and credits decrease it. That means that on December 15th, I would have credited my cash account by $2,400. I already said that the other side of the journal went to the insurance expense account. Well, expenses are the E in dealer, also a normal debit account. So to increase them, I would have debited the insurance expense account by $2,400. Here we have the initial journal entry. When I posted it, it would have hit both the cash account in the balance sheet and the insurance expense account in the income statement. We can visualize the impact of this journal entry on the general ledger using T accounts.
In T accounts, debits always go on the left and credits always go on the right.
So this is the result of that initial entry back in December 2018, and it would have been fine if we were cash accounting, because when we cash account, we record expenses once cash is paid out.
But the problem is, we're accrual accounting, so expenses should always be recorded as they are incurred.
And that means that our expenses at the end of 2018 are overstated by $2,400.
Time for our first adjusting entry. I'm going to show you how to record a prepaid expense. We're going to need to post this one into the December 2018 accounting period before it gets closed for good.
Our insurance expense account is overstated by $2,400, so our adjusting journal needs to clear all of this out. Last time we debited the account, so this time we need to credit the insurance expense account by $2,400.
But where does the other side of this journal entry go? We can't put this anywhere in the income statement because that will affect our profit for the year. That leaves us with one option, the balance sheet. But where in the balance sheet is a prepaid expense an asset or a liability? Well, there's an easy way to check this.
Assets bring us future economic benefit, whereas liabilities involve a future economic sacrifice. In this situation, I've already paid for the car insurance, so now it's down to the insurance company to provide me with coverage for the next 12 months. I'm going to receive the benefit of that coverage, so this prepaid expense should be recognized as an asset in the balance sheet. In fact, prepaid expenses are always recognized as assets in the balance sheet. That means the other side of the journal entry is a debit of $2,400 to prepaid expenses in the balance sheet. Let's update our T accounts to find out what impact this journal entry had on the general ledger. So at the end of 2018, we have negative cash of $2,400, no insurance expense in the income statement, and a $2,400 prepaid expense, which we're holding as an asset in the balance sheet.
This is exactly where we want to be. Now, when it comes to 2019, we have some more adjusting entries to post. 12 in total, one for each month of the year.
So let's bring up a timeline for 2019 and break it down into 12 accounting periods, from January 1st all the way through to December 31st. In accrual accounting, expenses are recorded as they are incurred. So we need to release our prepaid expense from the balance sheet as we consume or get the benefit from our insurance policy. In January 2019, I've consumed 1/12 of the insurance coverage. 1/12 of $2,400 is $200. So the insurance expense that we need to recognize in our income statement is $200 for January 2019. The adjusting journal entry that we need to post looks like this. We need to debit the insurance expense account by $200 to increase our expenses in the income statement. And we need to credit prepaid expenses by $200 to decrease our assets in the balance sheet. So with 11 months of insurance coverage left on the policy, we're carrying $2,200 of prepaid expenses as an asset in the balance sheet, and we've incurred an insurance expense of $200 in the income statement.
This process of releasing prepayments from the balance sheet needs to continue for the rest of the year.
At the end of May, we have consumed 5/12 of our insurance coverage, so we need to have posted this journal entry 5 times, recognizing a $200 insurance expense in the income statement on each occasion. With 7 months of insurance coverage left on our policy, we have $1,400 of prepaid expenses held in the balance sheet and $1,000 of insurance costs expensed in our income statement. 5 months of policy consumed over a 12-month period, which gives us $1,000. Likewise, you could do the same to work out the prepaid expense in the balance sheet. We have 7 months of coverage or future economic benefit left on the policy, so we have prepaid expenses of $2,400 multiplied by 7 over 12, which gives us an asset of $1,400 in the balance sheet.
Come December 31st, the adjusting entry we need to post is exactly the same as the ones that we posted for the previous 11 months.
Debit insurance expenses by $200 in the income statement and credit prepaid expenses by $200 in the balance sheet. However, this time we've consumed all of our insurance policy. We are no longer expecting to get any future economic benefit, so we are no longer holding any prepaid expenses in the balance sheet. This asset has been reduced to 0 because we have released all of it to the income statement, where we have recorded an insurance expense of $2,400 for 2019. Our cash account is still showing a credit for December in the prior year because that's when we paid for the policy. So we've recorded our expenses as we incurred them, and our books are in line with the accrual basis of accounting.
I love it when things line up, don't you? Now let's move on to deferred revenue, also known as prepaid or unearned revenue.
Deferred revenue is what we call the payments that a business receives in advance for goods or services that haven't yet been delivered or provided. You might have heard of prepaid revenue or even unearned revenue. Well, all of these are actually the same thing. They're just different ways of saying deferred revenue.
Okay, that's a bit odd. 3 different terms that all mean the same thing. Let's try clear things up with a couple of examples. In this first one, I want you to imagine that you're the owner of a seaplane. Random, I know, but bear with me.
I live in Vancouver, and for a while now, I've been wanting to visit Vancouver Island. If I were to take the ferry out there, this whole trip would take me 3 to 4 hours.
But lucky for me, you own a seaplane. So I head downtown to the seaplane terminal and boom, there's a spot on your seaplane and it's leaving in 20 minutes.
The ticket cost me $200, so I pay you the money and half an hour later, we're checking out the beautiful gardens on the island.
In this transaction, you're the seller and I'm the buyer. You provided me with a service by flying me out from Vancouver all the way over to the island. The question is, how should you account for this transaction?
Well, as the owner of the seaplane, you've received $200 in cash. Cash is a type of asset, the A in dealer, so debits increase it and credits decrease it. Your cash balance has gone up, so you need to debit your cash account by $200 to increase your cash. The other side of this transaction is going to affect revenue in your income statement. Revenue is the R in dealer, a normal credit account, so credits increase it and debits decrease it. Your revenue has gone up, so you credit your revenue account by $200 to increase your income. This is what your journal entry looks like.
And we can see how this journal entry affects your general ledger using T accounts. Sorry, I've got a sore throat today. This journal entry affects 2 accounts, cash and revenue. Remember, when using T accounts, debits always go on the left and credits always go on the right.
So we debit your cash T account by $200 to increase cash in your balance sheet, and we credit the revenue T account by $200 to increase revenue in your income statement.
Nice one. That's the first example finished. It wasn't so bad, was it? You're probably thinking, well, yes, because there weren't any adjusting entries in this one. You are spot on. This transaction didn't include any deferred revenue or adjusting entries of any kind because both the payment and services happened on the same day in the same accounting period. For deferred revenue to get involved in all of this, we would need a special set of circumstances. I would need to have paid you in advance in a past accounting period, and you would need to be providing me with the service in the future accounting period. I'll show you how this works in this second example.
This time, no more seaplanes. I want you to picture yourself as a commercial pilot on a passenger jet. It's June and I'm getting homesick. I want to buy a return flight from Vancouver to the UK to see all of my friends and family. It's been ages since my last visit, so this time I decide to go there for a whole month. I buy a return flight for $800 in June on your airline. My outbound flight is going to be the next month in July, and the return leg is going to happen the following month in August.
This is our timeline. We have 3 accounting periods: June, July, and August. To account for this transaction, you're going to need to post 3 adjusting entries, 1 in each month. So let's do the first one. In June, I paid for my tickets, but from your point of view at the airline, you received $800 in cash. You need to post a journal to debit your cash account by $800 to increase your cash. Right, up to this point, this journal is looking very familiar. It's basically the same as the one from the first example. You just need to post another $800 credit to revenue, and we're got...
This is embarrassing, let me think. You're a commercial pilot of an international airline. Large businesses like that use the accrual basis of accounting. But if we were to recognize this income right now, then we would be cash accounting, because in cash accounting, you record revenue as you receive the cash. Whoops, so I wasn't meant to credit revenue this time round because we are accrual accounting. Okay, I think I've got this now.
This time, we don't credit revenue in the income statement because we are accrual accounting. In accrual accounting, revenue is recognized as it's earned, not when cash changes hands. You haven't provided me with a service yet, so you can't recognize any of this revenue. So this entry can't go anywhere that affects the income statement. So that leaves us with one option, the balance sheet. But is deferred revenue an asset or a liability? Let's work it out.
Assets bring us future economic benefit, whereas liabilities involve a future economic sacrifice. In this situation, I've already paid for a plane ticket, so now it's down to you to fly me out to the UK and back. You've got work to do, so you are going to make a future economic sacrifice. So you need to recognize this deferred revenue as a liability in the balance sheet. In fact, deferred revenue is always recognized as a liability in the balance sheet. So the other side of this journal entry is going to need to increase our deferred revenue in the balance sheet. Deferred revenue is a liability, the L in dealer, so it's a normal credit account. Credits increase it and debits decrease it. So you need to credit your deferred revenue in the balance sheet to increase it by $800. Let's see how this journal affects your general ledger. Now you've got 3 tier accounts: cash and deferred revenue in the balance sheet, and revenue, normal revenue, in the income statement. Your cash account has a debit balance of $800 from my initial payment, and your unearned or prepaid revenue account holds a liability of $800. The normal revenue account is empty because we can't recognize any revenue at this point.
Let's fast forward to the end of July. You've flown me out to London, so half of my return trip is complete. If revenue is recorded as it's earned, then you've earned half of your income. The problem is, as things currently stand, you're holding $800 as a liability in the balance sheet. This deferred revenue is not the same thing as normal revenue that flows through your income statement. You're going to need to post an adjusting entry to fix this situation. Let's do it.
We'll start off by debiting deferred revenue by $400 because we want to reduce this liability in the balance sheet and release half of it to the income statement. But where does the other side of this adjusting journal entry go? We need to credit to the revenue account by $400 to increase our revenue in the income statement. Let's jot down how this adjusting entry is going to affect your tier accounts. We need to debit the left-hand side of the Deferred Revenue T account by $400 and credit the right-hand side of the Revenue T account by $400. So as things currently stand, you have cash of $800 from that initial payment and you are holding deferred revenue of $400 as a liability in your balance sheet. We've released the other $400, which we now recognize as revenue in the income statement.
In August, you fly me back to Vancouver, so the second leg of our round trip is complete. You have one more adjusting entry to post.
This adjusting entry is going to be exactly the same as the one that we posted previously. We need to debit deferred revenue by $400 to decrease it in the balance sheet and credit the normal revenue account by $400 to increase that in the income statement. You post this adjusting journal entry and it hits your general ledger. So in your August balance sheet, you are still carrying that $800 of cash from the initial transaction, but you no longer have any deferred revenue. Why? Because it has all been released to the income statement. $400 in July when you performed half of the services, and the other $400 in August where you completed the round trip. You have successfully recorded your revenues as they were earned, so your books are in line with the accrual basis of accounting.
Great success! Next up, we have accrued expenses.
An accrued expense is a past expense that hasn't been recorded or paid for yet. Let's pause for a moment and think about what this means. An accrued expense is a past expense that hasn't been recorded or paid for yet. So this expense will be recorded or paid out in the future, but right now in the present, we're still waiting for that to happen. Got it? This will all become clearer with the example that we'll get into shortly. But first, let's think about how a typical business transaction works. Imagine that we're the buyer and we want to buy something from someone, the seller. They send us the goods or provide us with a service, and in addition to that, they hand us an invoice. In return, we pay them in cash. Voila, transaction complete. With accrued expenses, the seller provides us with the goods or services sometime in the past, but we don't receive the invoice from them or make the payment to them until later in the future. Why does all of this matter? Because as financial accountants, we like to use the accrual basis of accounting. And in accrual accounting, expenses are recorded as they are incurred, not when cash changes hands. I like to think of payments as accounting triggers. When we pay money out of our bank account to a supplier, we code the payment to the relevant account in the general ledger. Receiving an invoice is also an accounting trigger.
When using accounting software like QuickBooks Online, you are required to enter the details from the invoice into your accounts payable ledger once you've received it. I'll explain how this works later in the example.
Okay, why does all of this matter? My point is that we have two accounting triggers, the invoice and the payment. If both of these are going to happen later in the future, then right now in the present, we've got a problem. We have no accounting triggers to record the goods or services when we receive them in the past. That's when the substance of the transaction took place. That's when the expense was incurred, and accrual accounting is telling us that we need to record the transaction here. But how do we go about accruing an expense in the past? I'll show you right now. Let's imagine that we own a business and there are some basic overhead costs associated with running our office. Things like electricity, heating, and water. We call these utility expenses. And for now, let's focus on water. In our office, we are billed for our water usage on a quarterly basis, 4 times a year. And on each occasion, the bill covers our water consumption for the previous 3 months. Today is November 1st, the first day of a new billing cycle. That means that 3 months from now, on the 31st of January, we'll receive a water bill covering 3 months, November, December, and January, 3 accounting periods. And to keep things simple, let's assume that water normally costs us about $50 per month. Let's jump forward now to November 30th. 1 month has passed and it's the end of an accounting period. Do we have any adjusting entries to post?
Yes, we do. We've been using water for a whole month, but we haven't received a bill or paid for any of that consumption yet, so we need to accrue an expense into our general ledger. And how do we do that? We post a journal entry. We need to recognize a utilities expense in our income statement. Water normally costs us $50 per month, so we need to increase our utility expenses by $50. Expenses are the first E in dealer. Normal debit accounts, so debits increase them and credits decrease them. Our utility expenses need to go up, so we debit our utilities expense account by $50.
But where does the other side of this transaction go? We are double entry accounting, so there is another side to this adjusting journal entry. We've already hit expenses in our income statement, so we need to temporarily hold the other side of this journal entry somewhere in our balance sheet in our accrued expenses account. But are accrued expenses an asset or a liability? Let's work it out.
Assets bring us future economic benefit, whereas liabilities involve a future economic sacrifice. We've already received economic benefit from this transaction because we've been using water for the past month, but we haven't paid for it yet. At the present moment, we are committed to making a future economic sacrifice, so we have to recognize an accrued expense as a liability in the balance sheet. Accrued expenses are always recorded as liabilities in the balance sheet. And liabilities are the L in dealer. Normal credit accounts, so credits increase accrued expenses and debits decrease them. So we need to credit our accrued expenses to increase them by $50 in the balance sheet.
Great. Let's see how this adjusting journal entry affects our general ledger using T accounts. We have two T accounts, the utilities expense account in the income statement and accrued expenses in the balance sheet. Remember, when using T accounts, debits always go on the left and credits always go on the right.
We debit the left-hand side of the utilities expense account by $50, and we credit the right-hand side of accrued expenses in the balance sheet by $50. So we have accrued a utilities expense of $50 in our income statement for November.
Now, let's jump forward to the end of December. Another month has flown by. Do we have any more adjusting entries to post? Yes, we do. We've consumed another month's worth of water and we still haven't received a bill or paid for any of it yet. We need to accrue some more utility expenses. The journal entry looks like this.
It's exactly the same as the one we posted last month. Why? Because we estimated that water costs us roughly $50 per month. So we need to recognize another $50 of utility expenses in December. And on the flip side, we need to increase our accrued expenses in the balance sheet by another $50. And how does this impact our books? Like this. Our utility expenses now come to $100, 50 of which was expensed in November and another 50 in December. In our balance sheet, we are now carrying accrued expenses of $100. This liability keeps getting bigger because we've now gone 2 months without an accounting trigger to settle this once and for all. We haven't received a bill or a payment in November or December, so we are making our best estimate of what the bill might be at this stage.
Okay, now we'll jump forward to the end of January, the final month of our quarterly billing cycle. The water company has sent us an invoice covering the past 3 months, and it comes to $153.
So it's not bang on the $150 that we expected, but that's okay. We used our best estimate and we actually came in pretty close. Like I mentioned before, I like to think of invoices as accounting triggers. Here's what I meant by that. When we enter this invoice into QuickBooks Online or whatever accounting software you're using, we need to categorize the transaction. And when we do this, it automatically triggers a journal entry that gets posted behind the scenes in our general ledger.
If you run a business and receive lots of invoices, then this automatic posting can become a huge time saver, and it's one of the many benefits of using accounting software. I'll pop a link down in the description to a free trial of QuickBooks Online so you can test it for yourself. It's an affiliate link, so by signing up, you'll have the opportunity to support me making more accounting tutorials just like this one.
The automatic journal entry looks like this. It debits our utilities expense account by $153 to increase our expenses. The other side of this journal entry is going to credit our accounts payable account by $153 in the balance sheet. I just want to point out at this moment that we haven't actually paid our water bill yet. We have only received the bill and now we have 30 days in order to make the payment. We owe money to the water supplier, so we have a liability in our balance sheet. How does this affect our general ledger? We need to credit our new T account, accounts payable in the balance sheet, by $153. That's the final balance of what we owe to the supplier. And we debit the utilities expense account in the income statement by $153. But hang on, our utility expenses are now $253. That's quite high. Our final bill was only $153. How does any of this make sense? We accrued $50 of utility expenses in November and another $50 in December. When we add the $153 that was automatically journaled in January, we get $253. Both our expenses in the income statement and our liabilities in the balance sheet are overstated by $100. That's because we have one more adjusting journal entry to post. We need to release our accrued expenses from the balance sheet. So let's do that. The journal entry looks like this. We need to reduce our accrued expenses in the balance sheet. Accrued expenses are liabilities, so we reduce them by debiting the account by $100. Our utilities expense account and income statement is also overstated. This is a normal debit account, so to decrease it, we credit the utilities expense account by $100. We post this journal entry into the January accounting period, debiting the left-hand side of accrued expenses in the balance sheet by $100 and crediting the right-hand side of the utilities expense account in the income statement by $100. When we close off the quarter, we have incurred utility expenses of $153 in our income statement, $50 which we accrued in November, another $50 in December, and then in January we took up a further $53. There are no more accrued expenses in our balance sheet because we released our $100 accrual in January, and we now owe $153 to our water supplier, which we recognize as a liability in accounts payable. We've recorded all of our expenses in the correct periods as we incurred them, so our books are in line with the accrual basis of accounting.
Well done on making it this far. We have one more adjusting entry to go, and it's called accrued revenue or unbilled revenue. You've got this.
Accrued revenue is revenue that has been earned but not invoiced yet. Sometimes you'll hear it called unbilled revenue, but accrued revenue is what it's more commonly known as.
That was the definition, but what does it really mean? Accrued revenue is revenue that we've earned in the past that we haven't billed the client for yet. So as of now, in the present, we haven't raised an invoice yet. That'll happen later in the future. I think it's easiest if we think of this in terms of a buyer and a seller. If we're the seller, then we provide goods or services to the buyer. Once we've done that, once the work is done, we send them an invoice and in return, they send us the cash. Transaction complete. We accrue revenue whenever we have provided goods or services in the past that we haven't billed the client for yet. At some point in the future, we intend to raise an invoice, and after we've done that, we'll receive the payment. You might be wondering, why do we do this? Why do we even bother? It all comes down to the accrual basis of accounting, because in accrual accounting, revenue is recognized when it's earned, not when cash changes hands. The issue with this scenario is that we provided the goods or services in the past. That's when we did the work, that's when we earned the revenue. But we haven't raised the invoice yet, and invoices prompt us to record transactions in our general ledger. So under normal circumstances, we wouldn't be recognizing this revenue until the invoice is raised, which in this situation would be sometime later in the future. So right now, in the present, we need to post an adjusting entry into our general ledger to recognize the revenue in the past when we earned it. Sound confusing? It's all good. Things will become a lot clearer with this example.
I want you to imagine that you're a web developer and I'm a small business owner who's desperately in need of a website. I've checked out some of your work and I have to say, I'm impressed. So I hire you to design my website for $500.
It's June 1st and you immediately get started. Come the end of the month, you've finished up your work and the website's live. I'm happy with the finished product and I'm ready to pay, but the thing is, you're busy with another job, so you don't get around to raising the invoice until mid-July. Let's work through the adjusting entries in this problem from your point of view. On June 1st, do you have any adjusting entries to post? No, you haven't done any work yet, so you haven't earned any revenue. What about June 30th? Yes, now you need to post an adjusting entry. Over the previous 30 days, you, the seller, provided me with a service by designing my website.
You earned this revenue, but you haven't raised the invoice yet. So you need to accrue this revenue into your books. How do you do that? By posting a journal entry. You need to recognize revenue in your income statement. Revenue is the R in dealer, a normal credit account. So credits increase revenue and debits decrease revenue. Your revenue needs to go up, so you credit your revenue account in your income statement by $500.
But where does the other side of this transaction go? We're double entry accounting, so there's another side to this adjusting journal entry. You've already recorded revenue in your income statement, so we need to temporarily hold the other side of this transaction somewhere in your balance sheet, in your accrued revenue account. But is accrued revenue an asset or a liability? Let's find out, shall we?
Assets bring us future economic benefit, whereas liabilities involve a future economic sacrifice. You've already made an economic sacrifice by providing me with a service in June, but you haven't been paid for this service yet. You're going to see that economic benefit later in the future, so you need to recognize accrued revenue as an asset in the balance sheet. Accrued revenue is always recorded as an asset in the balance sheet, and assets are the A in dealer, normal debit accounts, so debits increase accrued revenue and credits decrease accrued revenue. So you need to debit your accrued revenue account to increase it by $500 in the balance sheet.
Nice one. Let's see how this adjusting entry affects your general ledger using T accounts. You have two T accounts, a normal revenue account in your income statement and an accrued revenue account in your balance sheet. Remember, when using T accounts, debits always go on the left and credits always go on the right. You guessed it.
So you credit the right-hand side of your normal revenue account by $500 in your income statement, and you debit the left-hand side of accrued revenue in your balance sheet by $500. This adjusting entry has allowed you to recognize $500 of revenue in your income statement in June, when you earned it. Okay, let's fast forward to July. What happens when you raise the invoice? You need to post another journal entry. In this transaction, you're the seller, so you have raised a sales invoice. Sales invoices are recorded in accounts receivable. Accounts receivable is a subledger that tracks all of the amounts owed to you by your customers. It's a type of asset, the A in dealer, a normal debit account. So to record your sales invoice, you need to debit accounts receivable by $500 to increase it in your balance sheet.
What's the other side of this journal entry? You've debited something, so now you need to credit something else to keep your books in balance. Last month you took up $500 of accrued revenue in your balance sheet, and now you're about to take up $500 more of accounts receivable. You don't want to overstate your assets, so we can release that accrued revenue from your balance sheet now.
Accrued revenue is a normal debit account, so you decrease it by crediting $500 from the account. How does this journal entry affect your general ledger? Well, now you've got 3 T accounts: normal revenue in the income statement, accrued revenue in the balance sheet, and accounts receivable, which is also a balance sheet account. When you raised the invoice in July, you debited accounts receivable by $500 and credited accrued revenue by $500. You'll notice that your income statement hasn't been touched. You have still recognized $500 of revenue in June when you earned it, but you no longer have any accrued revenue in your balance sheet. Why? Because you raised a sales invoice. So this asset, these amounts owed to you, have been transferred to accounts receivable in the balance sheet. When I make the payment a few days later, you'll receive cash for your services. You'll need to debit your cash account by $500 because cash is an asset, and credit accounts receivable by $500 to close the invoice. This $500 asset, which you initially held as accrued revenue, has jumped from account to account in your balance sheet, to accounts receivable when you raised the invoice, and then to cash once you received the payment for your services.
There you go. Here's my adjusting entries cheat sheet. It summarizes all of the key points that I made in this video. And are you thirsty to learn more about accounting? If so, why not watch this video next? And I'll see you there.